Welcome to This Week in Money. I'm Jim Goddard. Today, Chartwork CEO Ross Clark examines how the markets reacted to President Trump removing the threat of steel and aluminum tariffs on Canada and Mexico. Sprott USA Holdings President Rick Reaugh gives us his opinion on whether BC and Vancouver's new housing measures could be considered racist. He also calls them a pure tax grab. Author of the book The Money Bubble, John Rubino, warns about the shaky state of real estate in Canada and the U.S. He also looks at how central banks might react to a stock market collapse. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartworks. He's the boss there. Welcome back to the show, Ross.
Good to be with you, Jim.
The stock markets, what was their reaction when President Trump said Canada and Mexico would be exempt, at least for the time being, from tariffs on aluminum and steel?
Well, he's the greatest negotiator, isn't he? He threatens you with the fact that nobody's going to have any way out of it, to the point where maybe Canada and the U.S. will, and then definitely they will, but it's part of NAFTA. So, you know, between the original announcement, then the one a week and a half ago, and then finally the Cohen resignation, or soon-to-be resignation, midweek, and then on Thursday with the NAFTA announcement, each one of these events has seen less and less of a sell-off or a reaction on the downside. So by the time you get around to Thursday's announcement, they backed off so much as far as the fears for the tariffs that the market was clearly it was set up for a good rally, and just finishing off the week in a fabulous way. We had been looking at sectors that were starting to show or maintaining their leadership during that February break. And, for all that the market was down 10 to 15%, depending upon sectors, the ones that have come back the strongest have been over in the technology side. The XLK, which is the ETF on that, closing off the week at a new high, and the names within that. So these are the non-industrials, which are really performing that well. You got your Microsoft, Intel, Micron, doing very, very well here. Those are the momentum plays, and that's really where the money's being made right now. We came out with providers of software for the website developments, GoDaddy and Shopify and Wix, a month and a half ago. These things are up 26 to 30% just in this last 2-month stretch. So there's still good things going on out there. You just got to make sure that you are in the stronger plays, not buying weak sectors and looking for quick bounces, but being in ones that have actually still got the momentum plays in them.
The U.S. had very good job numbers, 313,000 jobs created last week as opposed to an estimate of 200,000. How's that affecting the stock market?
Good numbers, help the stock market out really well. Put the bond market back down, close to its lows, because the concern is that, with that kind of employment, inflation will start to pick up. And, inflation's a good thing. You want to see some mild inflation out there. And, when you take a look around at, things that would hopefully be moving with the economy, I take a look at the copper market, and everybody over the years has called it Dr. Copper because clearly as the copper market has moved, it's been a good barometer of what's going on in the economy. And probably a quarter of the time, the copper market moves quite independent of the stock market. However, when you're making lows and you start to come back to life in the copper market, that has been a point where stock markets have done exceptionally well. And I look back at the S&P for the last 30 or 40 years, and there's probably only one or two instances where a movement to the up off of a support line in copper has not seen a good move in stocks. And where we are right now, I think is pretty darn important. You've had a multi-year decline in copper. We were at $4.50 back in 2011. A year and so ago, probably the end of 2016, we were down around $2, and we've recovered back to $3.25. Now, we've had 4 of these multi-year declines, if we go back through the 70s. And invariably, you get a 50 to 60% retracement rally, which is what we've now had. Into September, we'd been up to 320, and now we've had 3 attempts to try and get through that resistance. We've also then had small pullbacks, each one of them progressively coming in at a higher level. And this week, it was around 308, closed off the week at 314. The type of consolidation that we've been in September with this rising bias in it, this channel, 2 of those broke down in the past. If we were to close below 305, I think you could be looking at a 270 target. However, the one that held up well was similar to what we're seeing right now, was in 1994, and from there you saw a really nice move to the upside. And when I look at all of these interim highs and lows in copper, if this becomes an interim low here of this consolidation, that would be very supportive to the overall market. Probably not just the technology stocks that I was talking about.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark, CEO of ChartWorks. Coming up, Rick Reaugh, president of Sprott USA Holdings, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Reaugh shear zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Rick Reaugh. He's the president and CEO of Sprott Holdings USA. He's speaking to us from Vancouver. Rick, welcome back to This Week in Money.
A pleasure. Thank you for having me back.
Rick, you've just returned from PDAC, the Prospectors Developers Show in Toronto. How was the show?
I was so busy, to be honest with you. I don't know how the show was overall, although I suspect the fact that Sprott and myself were as busy as we were means it was a pretty good show for everyone else, too.
Yeah. And if people are wondering just how big is it, 1,000 exhibitors, 24,000 people show up. It's one of the biggest resource development shows in the world, isn't it?
I think it is the single biggest mining show in the world. Some of the oil and gas shows are bigger, although I should say, in fairness to BC, Roundup here in BC continues to grow and excel as well.
How important are these shows for people in the business?
They're absolutely critical, I think. It is a global business, and having everybody in one town, so to speak, in one room for 3 days, but really a week, is very, very useful. People reconnecting with people they did business a decade ago who you should have stayed in touch with, but the fact that they're in Johannesburg or Santiago or Perth means that you didn't. Being able to reconnect, being able to trade financial and technical information is absolutely critical. And by the way, inures enormously to the benefit of the nation of Canada, more than most Canadians know. The financial services and technical services around mining positions Canada in a way that's disproportionately large.
Why is that?
That's a really good question. I suspect that the regulatory acumen in Canada around mining, but more particularly the financial services infrastructure in both Toronto and Vancouver, are such that Canada, while it produces a relatively small percentage of the world's mineral wealth, dominates exploration and mining finance.
Plus, you would think, being the second biggest nation on the planet, we have a lot of natural resources that people don't know anything about.
Well, that could be too, but what's important is that you're providing financial and technical services to other people's resource extraction. It becomes a service industry in this country, which is an enormous employment multiplier well beyond the mine face.
How important is face-to-face contact in an age where everybody does everything on the internet?
Well, I just turned 65. For me, it's critical. There's all kinds of communication that takes place in, non-verbal, in informal fashion. And so for me, it's absolutely critical. I can't speak to everyone else. But my suspicion is that that sort of conference wouldn't be as popular as it is, were it not extremely useful for all of the participants.
Is it really true more deals are made over drinks or on the golf course than at formal meetings?
Not for me. I don't have the social skills to do that. I'm personally much better in a more formal commercial sense. As an example, at PDAC, every night there's probably 25 or 30 major hospitality events. And other than the awards banquet, where I always seem to know somebody getting an award, I don't go to them. I prefer to get my work done in more formal surroundings personally, although I suspect that I'm unique in that regard.
What was the mood towards junior resource stocks?
The junior resource industry always believes it's underfunded, which I think is sort of silly. There's lots of money available right now for good proven people with good projects. You've heard me say on your show before that, probably 80% of the public junior issuers are valueless. They're having trouble finding financing because they don't deserve to be financed. For ourselves, we have certainly experienced absolutely no difficulty whatsoever raising capital for proven teams with good projects. So while the industry is going to complain to you that they're underfunded, that just isn't true.
When you're taking a look at where to invest with these juniors, is it still important to get a hold of the CEO or other company officials and meet them face to face?
I think it's critical, and maybe not face to face for your listeners. If you invest in the size that Sprott does, where it's very difficult to get out of a position, it's absolutely necessary to know the people. A retail investor, I think, can get and maintain the information that they need in order to sustain an investment with about 1 hour of work per investment per month. So I like to tell retail investors, if you're going to have 10 stocks in your portfolio, you need to be ready to devote 10 hours per month to reading annual reports, press releases, 43 101s, quarterlies, and stuff like that. If you're going to invest in the size that Sprott does, particularly if you're going to become a project lender, of course you need a much, much, much deeper understanding of the company.
Do you think so many people think they've bought an ETF, they can just walk away?
I think a lot of people do feel that way. And that might, in fact, be the case, provided, of course, that you're comfortable with the volatility that comes with an ETF. Certainly, for people who like the narrative around the junior space, an ETF absolves you of the responsibility of doing the work. The nervousness that you have is, of course, that if you begin with the assumption that 80% of the companies on the exchange are valueless, the idea that you buy an index causes some complication because you wonder about the population of the index, how much of it is valueless. But I suspect, frankly, for many investors who want to be in the space, with a limited amount of money, which constrains their return on the hour a month in research necessary to sustain a position, that the ETFs are, in fact, for many of them, a better way to go. I, of course, would encourage the Sprott ETF for obvious reasons.
Does the Trump administration have a weak dollar policy, and is it good for commodity prices?
I don't know very much about what the real policies of the Trump administration are, to be honest with you. They say so many things about so many things. Certainly the fact that they are breeding uncertainty is bad for the U.S. economy and good for, I think, commodity prices. They certainly seem to be engaged in talking down the U.S. dollar. And certainly their trade policies are going to be bad in the intermediate term, both for the U.S. economy and for faith in the U.S. dollar and the U.S. economy. So I guess in the context of what you said, the probable answer is yes.
President Trump is promising to rebuild the steel and aluminum industries in the U.S. Is that bullish for all the components of steel and aluminum within North America?
No, it's a global market. I think his policies with regards to steel and aluminum are idiotic, and I think they're harmful to the overall economy, as well as being harmful to the steel and aluminum industries, which have both global markets and global supply chains. There is nothing that he has talked about with regards to steel and aluminum that is anything but harmful.
Has he taken into account that so many things cross both the Canadian and Mexican borders before they're finally built?
I think my feelings with regards to Mr. Trump are fairly clear. I don't know very much about how he thinks or what he thinks about, if he thinks about anything other than short-term political advantage with his base.
Is that very frustrating for people who are in the business of making sure they're making things most efficiently?
Certainly it is. If you are in industry and not a politician looking for short-term political gain, the fact that you operate in a global market and you have a global supply chain and you have global shareholders and you have global employees, the idea that any of those constituencies feel less welcome in your value chain as a consequence of your president is enormously frustrating.
Does he realize that most of the steel and aluminum plants in Mexico and Canada, or at least in Canada, are owned by Americans?
I think a more relevant question would be, does he care? Certainly, if he took the time to listen to his own advisors, it's likely that they would have informed him about that.
Was Gary Cohn right to walk away from being his economic advisor?
Well, again, you're asking me questions that are in some way, shape, or form above my pay grade. Certainly, I think, although I'm never in any danger of being an advisor to a politician, were I, and were my best efforts to assist that politician ignored, I don't see that I would have any choice other than to resign.
Is there a trend away from uranium for use in power plants?
No. Uranium utilization on a global basis is growing. There is a tendency, a political tendency, away from uranium in some Western constituencies that believe that they can ignore one of the most efficient sources of power in the world, although that's in fact a cynical belief. In Germany, as an example, they have reduced their direct use of uranium in Germany. What they've done, of course, is that they've substituted high sulfur, high ash coal, ironically blowing up their carbon compliance on a global basis, and they are importing electricity from both Poland and France, which ironically is produced from nuclear power. Politics is very, very strange.
Is cobalt the most in-demand component for electric vehicle batteries?
Not the most in demand, but it's the one that has the most interesting supply-demand dynamics. It's the first commodity that I've seen in 40 years in commodities markets where the users tell me that they would happily pay more if they could obtain more material. What I have been told by cobalt users is that there would be more fabrication technologies for cobalt if there was better security of supply. Normally, scarcity causes the price to go up. But in the case of cobalt, if you could take the productive capacity up, you could take the price up. I've never seen a commodity like that before. Of course, the challenge with cobalt is to get reliable supplies. One must go to either Congo or Russia. Congo being unstable socially, and Russia having some political challenges. What investors want is so-called politically secure cobalt. The problem with that is that there isn't any.
We'll have more with Rick Reaugh next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Rick Reaugh, President and CEO of Sprott USA Holdings. Rick, are you bullish on base metal juniors?
As a class, of course, no. Because as we said in the first episode, 80% of junior listings are valueless. if we are talking about a base metal junior that has a decent deposit in a good jurisdiction, and importantly is run by experienced, competent management, then the answer is yes. Remember that all of the performance in the junior sector, all the positive performance, is constrained to a limited number of parties. So when you ask me if I'm bullish on an entire sector among juniors, the answer will always be no. But I'm always attracted to special subsets within that class.
And which one of those special subsets really has your eye?
Well, that group of juniors that would be run by tier one people, be it Ross Beatty, be it Lucas Lundin, be it Robert Friedland, the very, very, very high-quality base metals juniors, of course I'm attracted to. But when you ask the question, am I attracted to the base metals juniors, as a generic question, the answer always has to be no.
Gold and silver continue to trade in a very, very narrow range, but do you see a breakout for them in the near future?
I don't know. That's above my pay grade. I think the economics of gold, that is, the deterioration of the American financial brand, which is, if you will, the collateral for the U.S. 10-year Treasury, is very bullish for gold. In the very near term, in terms of physical product, there are developing shortages of retail instruments, physical instruments in the gold business. But silver, in the very near term, is in physical oversupply. We are told by the retail bullion dealers that their suspicion is that the really highly speculative momentum and narrative buyers that generally populate the retail silver trade may have disintermediated over to the cryptos. We don't know that to be true.
Are you bullish on gold and silver juniors?
Again, you're asking me a generic question. I'm not bullish on juniors as a class at all. I'm bullish on special juniors. I do note that some of the junior gold and silver explorers are doing good work, and I remind your subscribers, probably needlessly, that high-quality silver stocks are in very short supply. Traditionally, if the silver price runs, the performance of the better silver juniors is spectacular, and if speculators are willing to do the work to choose amongst the juniors and find the better ones, and if they have the patience to wait out the oversupply of physical silver in the retail market, I suspect that the silver juniors over the next 2 years will do very well.
If President Trump gets the North Korean situation under control, would North Korea be a good source of minerals?
I don't think that we have enough knowledge to say. North Korea, as far as we know, has never been explored by modern technology. And the existing mineral endowment that they enjoy is probably a consequence of sort of 1950s Canadian technology. So it would stand to reason that a terrain that's reasonably well mineralized, were it exposed to technologies that originated in this century, should respond.
Is there much hope that talks with North Korea would actually pan out?
Again, that's way above my pay grade. I have no idea. The sort of bellicose nature of the participants doesn't give one much hope, but I'd love to be wrong.
Should we care about Bitcoin and other cryptocurrencies?
I'm a consumer of currencies myself. I spend U.S. dollars and Canadian dollars and Chilean pesos and euros. Any group of people that are conspiring to make a new currency to serve me better as a consumer generates wholehearted support. We ourselves at Sprott have been working for 2.5 years utilizing the distributed ledger technology to originate a token called Tradewind that will be backed by physical gold stored in a segregated account in the Royal Canadian Mint and be distributed and cleared via the distributed ledger, which we think has the potential to really disrupt physical gold trade. We've come far enough along with that technology that Goldcorp is now a shareholder, and we think a second major gold company will sign on as a shareholder as well. So we're fairly far along in our understanding of the technology, and we're very bullish about the technology. Whether or not individual cryptocurrencies utilizing various parts of the distributed ledger technology, are appropriate for individual investors is something that you should ask a commentator who is younger than I.
I've always wondered, cryptocurrencies, well, 99.9% of them have nothing backing them up. And I always wondered, shouldn't there be some kind of a physical asset like gold connected to them so that no matter if they go up or down, there's something that you can get out of them?
I think that depends on who you are. The utility in the cryptocurrencies is partly the ability to put in place a verification system that can't be counterfeited by a government. In other words, a community-based mechanism that isn't subject to the legislature, which seems always inevitably to become corrupt. And also the privacy and the anonymity offered up by the cryptocurrency. Your ability, as an example, if you live in Venezuela, to transfer Venezuelan currency into Bitcoin and have it magically appear somewhere else as dollars, something that is not available to you in other fashion. So there certainly is utility in the technology and the medium of exchange that can justify a price. For myself, I like my mediums of exchange to be defined by a store of value wherever possible, which is one of the reasons why part of my own savings are denominated in gold rather than U.S. or Canadian dollars.
Could you see cryptocurrencies someday replacing regular fiat currencies?
I would love to see that. To the extent that I didn't have to trust the U.S. government or U.S. society or the Canadian government or Canadian society, to the extent that my trust was placed in a community that verified things, I think that's a much more peaceful market solution to the problems of mediums of exchange. So I would love to do anything at all that disintermediated the power of the legislature.
If you're going to have a trading bloc like NAFTA, would it make more sense if they all use the same currency like the U.S. dollar?
I don't think so. I don't like to assign monopoly power to any legislature. I want to have legislatures competing for my trust. I would rather have 20 currencies than one.
Do you think the legalization of marijuana is going to lead to big problems in Canada?
I don't. Marijuana was de facto legalized in Canada a long time ago. One of the jokes that we've had internally is that with the proliferation of public marijuana companies, that the financial services industry in Vancouver is finally at the forefront of an industry that they understand well, where due diligence has taken place on street corners every night for 15 years. I think the legalization of victimless activities is always a good thing.
Do you think if they're going to legalize marijuana, they should legalize everything, regulate the hell out of it, and tax it?
I agree with the first part of your statement. I don't understand why you attempt to make things that don't harm other people a crime. If people steal to support a drug habit, the theft itself is the crime, not the drug habit. Now, I think you can tell from the rest of my answers that I'm not a big proponent of regulation, although I understand the need for some regulation, and I'm always appalled at any tax. If they did tax drug use very heavily, my hope is that it would be revenue neutral, and they would use the money raised by narcotics taxes to lower taxes on other beneficial economic activity. That does not seem to be the way that governments work.
It seems in Canada, even though it's going to be legal sometime this year, they believe, that they're throwing more obstacles in the way of it than really exist, because right now you don't see major problems with people driving stoned. In Washington State, I didn't see any riots when they made pot legal. Do you think the Canadian attitude is old-fashioned?
I don't. I just think that the legislature, as they always are, is inefficient. I think first of all that the policy, both at the provincial level and at the federal level, is supported by a large majority of Canadians. I don't think that there is very much broad-based political opposition, popular opposition to legalization, although I must say as an American I'm probably ill-placed to make that statement. Certainly in California there was overwhelming popular sentiment in favor of legalization of recreational marijuana. And, I personally believe that's a good thing.
Your thoughts on the BC government's new real estate taxes?
Theft of the highest order. The BC government is suggesting that they're doing it in order to make real estate more affordable. The idea that they're going to do that by confiscating the wealth of a high net worth Chinese person who owns a $5 million condo in False Creek is laughable. Just the same as the legislature's proposed luxury tax on automobiles. I suppose that's going to reduce traffic, too. The legislation at both the provincial and the municipal level puts a combined tax, discriminatory tax, of about 3% on non-resident owners. By the way, myself included, which is why I understand the nature of the tax so much. What that means is that the municipal and the provincial government in British Columbia stands to take more in tax than would be otherwise paid in rent on an annual basis on that property. In other words, in British Columbia, two levels of government are prepared to take 100% of the economic yield of a property. Or put differently, by tax, over 25 or 26 years, they're going to expropriate 100% of the net present value of the property. When foreign investors talk to me about investing and they talk about political risk, what I tell them is that the new proposals in Congo, where the Congo proposes to take 50% of the ultimate economic value added of a project, it makes Congo at least exactly half as confiscatory as British Columbia. I consider the legislation to be racist, that is anti-Chinese. I consider it to be nativist and populist. I think, ironically, that the jurisdiction that's come the farthest of any jurisdiction in the world to enact Trump's protectivist, nativist, racist, and fascist policies is British Columbia. I think what the BC politicians and Vancouver Council have done is to begun to raise a fiscal wall, very much like Trump's wall, around Vancouver. I think it's ironic that allegedly progressive politicians have come farther in implementing Trump's racist, fascist policies than he has.
How is the 2018 Sprott Symposium in Vancouver shaping up?
We anticipate that this will be the most well-attended and, of course, in terms of content, the finest symposium in this conference's 26 or 27-year history. We have every year upgraded the speaker list. This year it will include Jim Grant, in addition to the normal cast of characters, the David Stockmans, the Jim Rickards. We think it'll be fantastic. We anticipate, despite the grim political outlook for British Columbia, we expect to have 1,000 investors in attendance. We will have will be sold out in terms of exhibitors. You'll remember that our value proposition is that our customers, our attendees, consider our exhibitors to be content rather than advertisers. And the consequence of that is that no public exhibitor will be allowed if they aren't owned in a Sprott performance fee generating account. It doesn't guarantee that all those stocks go up. It just guarantees that we have vetted the exhibitors well enough that we've risked our capital owning them.
Rick, thank you so much for being on the show.
Always a pleasure. I enjoy the ability through you to talk to so many people around here.
My guest has been Rick Reaugh, President and CEO of Sprott USA Holdings. Coming up, John Rubino, next on This Week in Money.
I'm Brian Fowler, President of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to This Week in Money, John.
Hey, Jim.
What's your take on the Dow Jones Index? Some are predicting it could hit 40,000. Others are saying it's in for a giant dump. What's your opinion?
Well, this is one of those times when if history is any kind of a guide, certain things are pretty much guaranteed to happen, but it's not completely clear that history is a really reliable guide. So on the bearish side of the story for stocks, they're wildly overvalued. You know, by any historical measure that you want to use. U.S. stocks in particular, but a lot of other countries' markets as well, are at the very high end of the valuation range, which historically has preceded really nasty bear markets. You know, every time it's gotten to this point in terms of valuation, it has plunged, the Dow and along with the rest of the equity indexes in the U.S. So, you know, if history is going to repeat, major bear market coming. On the other side of the story, though, there's a really troubled world out there, with a lot of rich people in any given country wondering where to put their money if their home country is spinning out of control. And there's a decent chance that the U.S. is seen as a safe haven market when, for instance, the Eurozone spins out of control, or when China's credit bubble finally blows up on them. And that we get a lot of flight capital here, and a lot of that flight capital flows into blue chip stocks, which would make valuations irrelevant for a while. Sort of like with Vancouver real estate, Jim, during your bubble. Chinese expats didn't care what they were paying for trophy properties, right? They just bought nice condos for whatever the price happened to be and just left them empty as you know, like a bank account, place to store your money. Now, if equities in the U.S. see that kind of a flight capital inflow over the next few years, then, valuations really won't matter. They could go up again. So anyhow, that's a long answer to a question that really deserves a yes or no. Is it going up or is it going down in the next few years? So I wish I had a definite answer for that, because there's just so much going on that's really interesting and both scary and encouraging right now from the point of view of stock investors, that I really don't have a good answer,
Are the U.S. and Canada on the verge of housing collapses?
Not collapses, but definitely downturns. We've had really nice runs in home prices. You more so than us even now. The U.S. home prices on average are back up to the 2006, 2007 record levels. But in a lot of Canadian cities, trophy properties are higher than they've ever been before. And, you're already starting to see it, right? Toronto home sales are down dramatically. And Vancouver, as we talked about before we went live, it isn't the bubble market that it previously was, because some foreign money, or the torrent of foreign money has slowed to a smaller torrent, or even a trickle. And that's leading prices to plateau and maybe fall. And then, the thing about real estate is that it's a leveraged asset. Most people borrow money to buy houses. And that means there's, at price extremes, there's an air pocket under the market price for a lot of real estate, because if people start to lose money on their leveraged asset and are forced to sell it, they don't really have a choice about the price. They got to take a lower price, and so real estate markets are roller coasters, in at least during the the credit bubble period since 1971. Which means that when you get to an extreme high, you've got a big drop coming. And, in the U.S., nationwide home prices fell during the Great Recession, when the housing bubble burst, across the board for the first time since the Great Depression. We hadn't seen home prices fall in a 2 or 3 year period since 1935 or so. But they did. They fell hard. And now prices are right back up to where they were. The amount of leverage that we've used to take on new real estate obligations is back up to near record levels in a lot of places. And I think it's still record levels in Canada, right? You guys have leveraged yourselves to the hilt in a lot of different ways. And history says you'll pay a price for that. In the U.S., we have also leveraged ourselves to the hilt in a lot of different ways. We've got a mini bubble going on in real estate, but a bigger one in subprime auto loans, and an even bigger one than that in student loans. Meanwhile, consumers are back to maxing out their credit cards again. So something will happen to freak out the credit markets in the not-too-distant future. And because of that, I think volatility is one of the few really good bets out there. Just expect things to bounce around. As we come to terms with this new world of rising interest rates and soaring government deficits and all the other pathologies that flow from a debt bubble, late-stage debt bubble, the question when the financial markets do freak out is, how will central banks respond? If they do what they did back in the pre-quantitative easing world, they'll let it run a little bit. They'll keep on raising interest rates to try to stabilize inflation, and they'll accept that the financial markets are going to drop. We'll have a revaluation of stocks through a bear market. If they're going to stay with new age finance of the past decade, they'll intervene instantly by cutting interest rates, not just to low levels, but to negative levels, and they'll start buying back bonds again, and they'll probably extend the financial asset purchases to equities and maybe even real estate. It'll just go on and on. We'll see, quantitative easing of the past 10 years doubled down on. They will see $4 trillion of new assets at the Fed and raise us $10 trillion of new assets at the Fed, which means that the money supply will just soar worldwide. That's when you want to be loaded up on precious metals. when these guys just let loose because they're totally panicked, and they don't have any tools except the same old tools of low interest rates and higher government spending, and huge amounts of currency creation. And, I think at that point it creates a tsunami of terrified money flowing into safe haven stuff like precious metals.
Are the debt bubbles in Canada and the U.S. likely to violently burst?
Yes, all debt bubbles burst eventually. And as I said, this is a little bit different because we got these central banks standing back there, ready to jump back in with crazy experimental new monetary policies, which changes the dynamic of a credit bubble a bit. But it also lets the credit bubble expand to levels that it wouldn't have otherwise, because you've got all these traders out there thinking, the Fed has our back. Whatever happens, no matter what stupid risks we take on, they will be there to bail us out. So let's take on some risks. Let's generate a lot of fee income in this year, which translates into a big year-end bonus for us all. The guys taking on the risk, and then we'll worry about what happens later. That's been the attitude of the big banks for the past decade or more, and it hasn't changed a bit. Derivatives books are through the roof, and other kinds of leverage are soaring again. So it's the same old, which blows up in the same old way. And so the question is, how far will the blow up be allowed to progress before the central banks jump back in and try to stop it? I don't know. I suspect it won't be very long. A 20% drop in equity prices would probably get us a new round of QE and a 0% short-term interest rate, and back to 2% on 10-year treasuries. They would try to replicate the quote-unquote success of the aftermath of the Great Recession, but they'll have to do it with bigger numbers. And at some point, those numbers become so big that they become counterproductive. And we'll see if this time around is that time.
Is President Trump's economic advisor Gary Cohn's departure from the White House a good thing?
He was seen by Wall Street as Trump's adult supervision, because he was your standard mainstream Goldman Sachs guy, right? He was in favor of free trade, which primarily benefits the 1%, who can sell their stuff globally, and lower taxes on corporations, which primarily benefits the 1% who owns corporate equities and who, in a lot of cases work for big corporations, and big government deficit spending, which pretty much benefits the political class. And Wall Street loves those policies. So to the extent that they had a guy there pushing those policies, they were, by and large, happy with the Trump administration. Now you take Cohn out of the mix, and you're left with a bunch of what Wall Street probably perceives as protectionists and people who just don't understand how a modern banking system works. And so they're worried now that we're going to start a trade war with China and also Canada and Mexico here in North America, and that's going to cause trade to shrink, and in that way impoverish the rich guys who make so much money off of foreign trade, and lower the value of U.S. multinationals, which tend to benefit in a free trade environment. So now Wall Street's worried about that, and trade wars frequently lead to currency wars and shooting wars and stuff like that. So it adds an element of instability to a world that for a while there Wall Street thought was nice and stable. And so what's happened in the financial markets reflecting this is you're seeing big spikes and then big drops in the stock market. It's gotten very volatile after a couple of years of extremely low volatility. And the reason for that is that it's starting to appear now to more and more people that we're at the end of a cycle, that business as usual of the past few years can't really continue because we're creating imbalances. And the federal government is enacting policies that contradict those of the past few years, that revise them and reverse them, and lead to greater volatility in the political sphere as well as the economic sphere. So, everybody's getting worried now. Cohn's departure is the latest in a drumbeat of disturbing news over the past, say, 6 months or so. We kind of tend to forget that as of last autumn, we were in the middle of one of the most stable periods of finance and economics that the world has ever seen. You know, the stock market was going up year after, or day after day after day, and every top line number was a little bit better than the top line number that governments reported the month before. You know, it was just a really nice, stable time. But as the old saying goes, stability breeds instability. High prices breed low prices, and vice versa. And so we've had high prices and stability for quite a while. So it shouldn't be a surprise that we're getting instability now. Now, will that instability lead to much lower prices for financial assets? Maybe. This isn't a bad time to be shorting a lot of the really high-flying, FANG stocks and other blue chips out there that are at their all-time highs. At the same time, they've been buying back record amounts of corporate equities with borrowed money. You know, we've created the conditions for a bear market, and let's just see if it happens.
Following the Italian elections, the two parties that gained the most votes are anti-European Union, anti-immigrant. Could they be a catalyst for the breakup of the European Union?
They could be a catalyst for instability within the European Union for sure, because if Italy were to try some kind of Brexit type thing where they literally leave the Eurozone and decide they don't want to use the euro anymore, they want to go back to the lira and then devalue the hell out of it, that would be extremely destabilizing, because Italy's the third biggest economy in the European Union. You know, Germany, France, then Italy. So this isn't like Greece, which is, a rounding error in the EU, or Britain, which was never really, part. They were part of the EU, but they weren't part of the Eurozone. So there aren't trillions of dollars of euro-denominated debt that Britain's going to have to switch back over to pound sterling-denominated debt. So Greece and Britain weren't nearly as serious a threat to the stability of the Eurozone as Italy could potentially be. There's a lot that has to happen before you get a real, functional, active, anti-Euro, anti-EU government in Italy. You know, we're not there yet, but it looks like it's possible that a coalition that leans in that direction takes power pretty soon, and that'll be a big deal. You know, it'll scare a lot of people, in part for what it means in the here and now with Italy, and in part for what it means about political trends going forward in Europe. Because there are other countries that are not doing well under a Euro regime that's dictated by Germany. And so their upcoming elections, whether it's Portugal or Spain or, Greece again, their elections are going to be contentious with populists gaining votes, if not actual power. So the question will become whether Italy is the start of a trend or this one-off problem. If it's a one-off problem, they can deal with it. If it's the start of a trend, and you're going to end up with 4 or 5 countries all in the same boat, then the Eurozone has a serious problem. And one of the things about today's world is that nobody has a problem without it becoming everybody else's problem. You know, we're so interconnected that if the euro is destabilized by European politics, then its value will go down. Basically, it'll be devalued really aggressively, either by the markets or by the European Central Bank overtly. And that means the dollar will be going up relative to the euro. Well, that hurts our trade. You know, that's one of the reasons why we've had such a lackluster jobs market and relatively slow growth since 2014, and because the dollar went way up. You know, that hurts our ability to export stuff. So now we're forcing the dollar back down, or letting the dollar fall, and presumably that'll help us export to the rest of the world. But if the euro tanks versus the dollar, then all of a sudden we're back to where we were in 2015, 2016, with a currency that is a headwind for the economy. And, we're so indebted. We can't really manage external shocks like a spiking currency very easily anymore, because we're taking on more and more debt every year on top of a mountain of debt that is already historically unprecedented. So you need extreme stability to manage an extremely high debt load. So anything that leads to instability increases the odds that this mountain of debt that we've taken on blows up on us.
The Obama administration had a strong U.S. dollar policy. Does it look like the Trump administration favors a weaker U.S. dollar?
I'm not really sure how much control governments actually have over their currencies. They say words, but in the end, they tend to think of the currency value as a side effect of the real stuff that they're doing. Obama borrowed $1 trillion a year in the U.S. He doubled the debt that George W. Bush had taken on when, the Bush administration doubled the national debt on its watch, and Obama doubled the national debt again, and ran massive deficits, which leads to the debt increasing. And that kind of thing affects the currency markets as a secondary or tertiary effect, because you get growth effects and interest rate effects from borrowing huge amounts of money, and then they translate into currency values. So anyhow, the dollar went way up under Obama, although I don't think that was really his intention. The dollar is falling pretty hard under Trump, and really his intention either, although it helps with his policy of, America first in trade, because devaluing your currency is one of the things you do when you're trying to gain a trade advantage. So whether they engineered it or whether it happened just as a natural consequence of the dollar being too strong for too long, I don't know. But it is working out that way. And it shouldn't be a surprise that European instability increases when the euro goes way up versus the dollar, because all the effects of the weak currency for the eurozone of the last few years, which was great for international trade, are being reversed out. Because all of a sudden it's hard for French companies or German companies to sell their stuff into the U.S. because their prices have in effect gone up by 10 or 15 or 20% because of currency fluctuations. So the instability in Europe can be traced partly back to a suddenly strong euro. Anyhow, currency fluctuations, though, are just back and forth squiggles in the long downward arc of fiat currencies. They all get value, they get less valuable year after year after year. But these currency fluctuations that we talk about, strong dollar, weak euro, vice versa, those are fluctuations against each other, where one currency is up and another currency is down relative to themselves. But their real value is falling year after year after year. And that's the important thing that we should be paying attention to, because countries are going to have currency policies that last a year or two and have a certain effect, but the big policy of borrowing too much money and creating too much currency and encouraging the private sector to take on way too much debt, those policies aren't changing. They're the same year after year after year, and they lead to the same effect, or the same outcome, which is a currency that gets less valuable year after year after year. And the question for that kind of a policy is, when does it blow up on you? When do people figure out that this currency is not worth holding because it gets less valuable every year? So why not, when you get some of it, convert it into stuff that probably doesn't get less valuable year after year? That's part of why cryptocurrencies had such a huge run there, because people are looking for a way out of these fiat currencies, which is to say, when they see another form of money that looks like it might have some advantages of stability and price appreciation versus fiat currencies, everybody's jumping into them. They see this as a better deal than dollars and euros and yen. Soon they'll make the same decision about gold and silver, which are older forms of money that can't be just inflated away the way we're inflating away all these fiat currencies. And those things will start to soar. So I think it's possible that we'll see cryptocurrencies and precious metals start to behave really similarly going forward, where they're all going up, but it's not so much that we've reevaluated our opinion of those things or they've changed in a fundamental way. It's that we don't like the fiat currencies anymore. And we're looking for ways to get out of them and choosing these other forms of money as simply a better deal going forward.
Any time range on that rise, or do you have to be patient?
That's the problem with all of this stuff. It could happen tomorrow, or it might not happen for 5 years, because we're in uncharted territory with central banks behaving the way they're behaving. If we had, quote-unquote, normal central banking, let's say the central banks of the 1970s or 80s, it would have already happened. We would have already had a currency crisis that led to a huge bear market in financial asset prices, and we'd be back to possibly, price levels for currencies and for financial assets that would allow us to move forward in a sustainable way. But because everybody assumes the central banks are going to bail them out, they just kept on going with the debt orgy. We had governments continue to borrow huge amounts of money and corporations taking on record amounts of debts. Consumers everywhere maxing out their credit cards and their car loans. And so now we're at the point where this could blow up instantly and just, give us 2008, 2009 on steroids, much worse than the Great Recession. Or it could continue for a while as central banks facilitate an even bigger credit bubble. But eventually it blows up, and the longer it goes on, the bigger the consequence will be. So it's better for us if we get it out of the way now. It would have been better to get it out of the way 20 years ago and just had a almost Great Depression in 2000 after the tech stock bubble burst. And then we'd be in pretty good shape right now. But instead, we basically maxed out the world's credit cards to maintain our lifestyles for another couple of decades. And now the consequence of that mistake is just going to be huge, but we can't know whether it's now or 5 years from now. That's something that we'll only know in retrospect. And a few people who place big bets and get the timing right will be household names. They'll be famous, and we'll all wish we could have done it just like they did, but it's really unknowable. You're kind of guessing about the timing at this point, and there's nothing you can do about that.
Does the cobalt market have room to grow?
Well, cobalt is an ingredient in today's batteries, and electric cars are taking the world by storm. You're seeing major car companies talk about going all electric in just a few years, and entire countries saying that they're phasing out internal combustion engines on a pretty tight timetable. So there are going to be a lot of batteries demanded in the world. Cobalt is one of the ingredients in today's battery tech, and there's not enough of it around at the moment to satisfy the demand of, say, 5 years from now projected. When there are electric cars everywhere you look, and solar panels on roofs with batteries in basements as a replacement for a heat pump and a connection to the grid everywhere. So if that technology turns out to be what we go with going forward, in other words, lithium-ion batteries of today's design, if that's what we end up using 5 or 10 years from now, then we're going to need a ton more cobalt. And ton being just a figure of speech. It's actually going to be thousands and thousands and thousands of tons of cobalt. So the companies that have working cobalt mines are in pretty good shape right now. The price of their product ought to go up with time. And countries that have a lot of cobalt resources that are untapped, and Africa is one of the big places where it exists now, we'll probably see a lot of mining development going forward. Now, the flip side of that is that if the price of cobalt goes way up, that means the price of batteries go up too. And that slows the transition from internal combustion engines to battery-powered cars, and might open the door for something like fuel cells to become the battery of choice for next-generation electric cars. There are fuel cell cars being developed right now that seem to work just fine. And they've got a problem with an infrastructure of hydrogen pumping stations out there holding back the ability of hydrogen cars to spread, because it's really hard to find hydrogen for your car right now, except for little parts of California. But if battery tech doesn't drop the way it needs to going forward, it can't just be stable here. It's got to get better and better for electric cars to take over the world. Then maybe fuel cell cars end up being the ones with legs, and because you can make hydrogen, very plentiful element there. It's right now it's kind of expensive, but we're finding ways to make it more cheaply, and to develop more efficient fuel cells that are cheaper to run. So the interesting thing, or the exciting and scary thing about new technologies like this, is that you really don't know how it's going to play out, because there are a lot of different possibilities. It looks highly likely that gas-powered cars, internal combustion engine cars, are on the way out, and that within 20 years, actually, Jim, let's say you and me, 5 years from now, when we go to buy our next car, we're not even going to bother with internal combustion engines. We're just going to look at the electric cars that are on the market, right? Because they're so much cooler, more fun to drive, just a way better experience than internal combustion cars. So the world will have changed that much within 5 years, where we only look at electric cars. But certain things have to happen in the meantime. And you, first of all, don't know for sure that they're going to happen, like prices have to plunge. And you also don't know whether some new technology comes along in the interim and starts to displace the previous revolutionary technologies, like lithium-ion batteries. So you just can't know exactly how it's going to play out, and that makes it a little bit harder of an investment thesis, because if we were guaranteed that lithium-ion batteries of the current configuration were going to be the thing we use a decade from now, you could place some bets with a high degree of certainty on stuff like, lithium mines and cobalt mines, and even copper, which goes into electric cars, and actually silver. Silver's a part of electric car design too, apparently. So those things could be bought with a high degree of certainty that the price was going to go up, if we knew that lithium-ion batteries were the things we would use 10 years from now. We don't know that for sure, but it's a pretty good bet that that's the case, which means a lot of people are jumping into the raw materials, the picks and shovel side of the electric car market, expecting it to happen, and maybe it will. It's just that if you look at the history of revolutionary technologies, a lot of the early names don't end up being the brand names in that market today. It could well be that way with cars, but I think the revolution itself is almost a lock. We're almost certainly going to be driving mostly electric cars a couple of decades hence, which is, generally speaking, a really good thing for the world. It's just not totally obvious and easy to make money at it right now.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Reaugh, and John Rubino. And thank you for listening. If you have any questions for the show, you can email us at info@howstreet.com. Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, always glad to talk to you, Jim.
Finally, some financing has closed for your company. Can you tell us about it?
Well, we announced a $1.5 million financing at the beginning of, or the end of January or the beginning of February. And we closed it in 2 tranches, and we closed the last tranche on Friday, and that took us to an oversubscribed level from $1.5 million to a little over $2 million. So it was very successful, and it certainly loads the company up with the money that's required to move this through the next stage. We've announced that with Cometco earlier. And what's really intriguing me and exciting me is what's happening in the commodity markets with especially cobalt and now nickel. And I'd like to maybe go into a little detail on that.
Well, Larry, can you run down some of the commodity action?
Well, today the price of cobalt is $84,500 a tonne. Now that is a significant rise in the last week, and it's really pointing the direction. I predict that we'll be over $100,000 a tonne by midsummer, and where it goes from there, it could go a lot higher. But this is going to also increase the costs of electric vehicles, and that could slow down the growth somewhat. But not necessarily that much, because they're certainly looking at NMC as being the preferred. That's nickel, manganese, cobalt being the preferred chemistry moving forward. And NMC has different levels of the amounts of cobalt in it. And as you move down the ladder, the cobalt gets less and less and less. Now, that would certainly cut into our profits, but, you know, still looking at the value of the cathode materials, it would still be a very robust situation for us to follow up on. And so we are moving ahead. Now, what are they replacing the cobalt with? Well, nickel is the big one. And nickel produces a nickel sulfate for the battery industry. And there's not a lot of that going on. Most of it's pig iron for the stainless steel industry, and I'll return to that shortly. But they're going to have to increase the amount of nickel sulfate. And I know that the London Metal Exchange is looking at setting up a platform within the exchange on lithium sulfate. So, what's that mean? Well, nickel prices are going to start increasing, certainly for the sulfate. And, you know, we're looking at $6 a pound now. 2 years ago it was $4 a pound. And it actually went as high as, God, I'm trying to think of what the number would be, but close to $100 a pound back in 2006 and 2007. So you can see that nickel could have a long ways to go, but that was mostly driven by the stainless steel market, and after they introduced pig iron into the equation, that they were getting the nickel supplies from low purity deposits out of the Philippines, and the Philippines principally, but also there was another country, and I just can't think of the name of it right now. But that flooded the market, brought the prices down, and it also brought the prices of the manganese metals down, because manganese metal was used heavily in 200 series stainless steel, and that's what propelled the price upward. And of course, the Chinese reacted to that market by building dozens, if not hundreds, of manganese metal factories in China. And so there was overcapacity, and the fact that nickel prices were dropping through the floor, and a better product was made for stainless steel out of nickel, so the stainless 200 kind of fell off the table. With the scenario we're seeing today, the stainless 200 could come back on the table very soon, and that would be very good for our project in Arizona at Artillery Peak, because we produced a pre-feasibility study on that, and it wouldn't take much of a bump in price to bring it back into the black. But right now, currently, the prices haven't changed. We're not seeing much change in that direction, but I will be talking more about manganese in another podcast. And but I'm pretty excited about what's happening out there. Everything I see has a positive spin for the company. I mean, we're exposed to 5 different commodities. In our recycling, we can increase the manganese one by Artillery Peak, but then we're exposed in 2 areas. And, of course, we're exposed in the cobalt area with our prospect up at at Hazelton, which the Australian company is going to be starting work on this summer. Now, that said and done, we have as much chance as any cobalt explorer out there of making a significant find. So I got my fingers crossed on that one. But the nickel is something that I've been thinking about for a while, and I see it's finally hit the mainstream press. And I just wanted to comment on that because more nickel production or nickel sulfate for the battery industry, the lithium-ion battery industry, certainly is also a plus for us. We're not exposed in any properties with nickel, but we certainly will be heavily exposed in the recycling. So that is, I think that's a great thing to look forward to for our shareholders. Everything seems to be a perfect storm for the company, although you wouldn't be able to tell that with the markets eroding the way they are. I still believe that American Manganese is in a very good pattern here for anybody that wanted to invest in it. So I think that's about all I got to say on that, Jim.
Larry, where are you traded, under what symbols, and how can people contact your company?
Okay, we're traded on the TSX Venture Exchange under the symbol AMY. We're traded on the over-the-counter in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. People can do due diligence on us. There's a lot of information on our site at AmericanManganeseInc.com. They can email me at LREAUGH@AMYMN.com, or they can phone at 778-574-4444.
Larry, thanks for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. We were speaking on March 9th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.